Good morning. It is Friday, the 15th of January. A couple of things. We've had a busy week, and so there's a lot to talk about. But first off, we'll talk about the weather. It's snowing down here. And this week I was watching one of my favorite weathermen, and he said that in this area, most of our snow, and I don't remember the exact percent, comes after January the 15th. So for those of us that like winter, that's something to look forward to. But I don't recall, but January 15th to April the 20th or something was most of our snowfall for any year, and we typically get around 19 inches for the year. So I'm a little excited about that. Then behind me, I just realized I've still got my Christmas trees up. So January the 15th means I need to take my Christmas trees down and get ready for Valentine's Day. This week, Chairman Powell came out with the Fed. He's got about a month left on his term. And the statement he said is relatively positive. I got a couple of negative things I want to point out, but the positive thing that he said this week was that he thought the economy would return to normal, in his words, quote, fairly soon. And he attributes all of that to the monetary and fiscal policy that has been negotiated mostly through the Fed, some of it through Congress. Under Trump, we've contributed, I think, $4 trillion. And now the new administration is looking at another $2 trillion. And so Powell is saying that a lot of that has to do with the economy perhaps recovering a little bit quicker than we had thought. Our unemployment was at a 50-year low on February 2020, and then we lost 20 million jobs because of COVID. That was a pretty big hit. Our unemployment took off, started competing with where we were in 1929. But right now, our unemployment's down to about 6.7%. And at the end of this, you'll see a slide just reaffirming what I said last week, where I think we're going to be this year. So there is some positive news, a little bit negative this week. We'll talk about that. The other issue over 2020, which we're recovering from, is a GDP contraction of about 33% in the second quarter. That was an anomaly, something we haven't seen in years, and that also is recovering. So let's go ahead and hit our slides for the week and see where we are. We've adapted some things. The Dow Jones Industrial Average has been relatively quiet, and I expect it to be that way for the next 5 or 6 days. We're going to talk about one of the most common questions I've gotten this week here in a second. But you can see the Dow Jones Daily Average is the blue line where you had that deep dip. And now if you come way back over here on the right-hand side, you can see that we went flat for a little bit here through December. We typically get a Santa Claus rally around Christmas. Didn't really see too much of that, but we've got kind of this bump going on here in the last week or so, and that's relatively positive. Something that we talked about last week, as the first 5 trading days of a year go, generally so goes the rest of the year. That should be good news for us. January 2nd was a bad day. We were down about 370 points, but we have since recovered, and the next couple of days were pretty decent. We're still sitting here above 30,000, and I hope that's a support level that we can keep. So we'll be watching for that. Next slide, Valerie. This is our world markets, and what I've done here is I just wanted to show how we did on 2020, where we ended up. And you can see that everybody was positive. You've got Japan, Germany. Down at the bottom, you can see where the United States was. And we basically recovered to about where we were at the end of the year, December 31st of 2000. That should say 2019 up there. So Japan was up 4.57%. Now, the interesting part about that is Japan's borders are now closed to anybody that's not a citizen until January 31st. And they've done that because of the virus. Their economy seems to be trucking along nicely. And if you go down to the UK, that third one down, that's Britain, and they have shut their country down again for another 3 weeks as a reaction to the new part of the virus. So we'll have to watch and keep an eye on those because they're taking some pretty draconian measures to try and fight the virus and see what happens. I don't see us ever getting to that point again. We'd have to determine that. The possibility of us closing our borders to all but U.S. citizens is non-existent. Japan's successful doing it, but I can't see us pulling that off. So they're surviving. They did okay, and we'll see how they go in 2021. Then this is our unemployment claims. And my concern here is what's happened in the last week. We went up to almost 1 million new filings in 1 week, which was a frightening number. So The issue now is number one is let's make sure it's not an anomaly. Let's make sure the reports are accurate and where the reports are coming from. But then the second part is that jump to 980,000, 985,000 initial claims is a little bit alarming. So it could be coming from a couple of things. One is it could be from a little error after the holidays. The other one, it could be people losing jobs after the holidays, the box stores, service industries cutting people and getting rid of those jobs again. So that's possible. So next week's going to be really important to see how we do. My concern is that orange line, which is the moving average, if that starts turning up, then I'm going to be a little bit concerned. Mathematically, it's going to take a lot to get that turned up because of this huge bump back here in March. But we're going to be taking a really close look at this and where we go when that comes out next Thursday morning. But right now, we're a little bit concerned about that, and we'll just have to keep an eye on it and see what happens. This is the sector performance. And again, what I've tried to do is use colors to show you that each sector is the same color. So you look at the top where telecommunications is, that's a nice blue. It was the second highest performing sector the first 3 months of the year. And then from March 25th to the end of the year, it was number 3. And then from January 2nd, just this past period, it's back to number 2. So when my partner and I put together our sector analysis and decide how we're going to invest, this is a lot of what we use. The only thing is that right now we're looking at gas and energy. We're not sure how that can go any lower. For instance, one of the other things that happened this week that's important is OPEC made an announcement, and their intention is to decrease production to increase prices. Now, basic businesses, there's 3 tenets on how you do better. You either sell more, you sell it for a higher price, or you spend less to make it. What OPEC does is they basically say, well, we're going to make less, and then that's going to increase demand, which increases prices. And there was some immediate effect on that. A barrel of oil now is up over $50. So considering where we were literally 3 or 4 months ago, it was down to 30. That's had a pretty big impact. So now it's where that happens next. And that sector itself will be impacted greatly as COVID is managed and hopefully gotten rid of. As the leisure industry comes back, people get in their cars, people get on airplanes, people get on trains, and that's where a lot of the oil and gas is consumed. To some extent, the oil that's being used and the petroleum that's being used in the aviation industry is a fixed expense, because if you're flying a plane from A to B, you're going to use a certain amount of fuel, and then you put passengers on it, use a little bit more fuel because of the weight. But what they'll be doing is adding more flights, and they'll be using different airplanes. And so that will increase in production. We'll see what happens to that sector itself, because the demand will go up and probably the pricing, and there's an opportunity to take advantage of some of that. So the next slide here is our volatility index. The comfort that I have here is that typically this leads the market a little bit, and not by a whole lot, but we can still see some stability in the volatility index. It's still kind of flat, running right now around 20, 21, 22 points. Obviously, we'd like to see it down at 10, 12, or 13 as it ran for a couple of years, but we're pretty satisfied right now that it's leveled off. It's kind of flat. It's been that way since about Thanksgiving. And we've seen a little bit of bumps. We'll see a little bit, maybe a bump next week when we have an inauguration. We might see a little concern there, but we'll keep an eye on that one. Right now, we're pretty satisfied with where it is. This is the most common question I've gotten this week, actually for about the last 2 months. It's increased this week, and I expect it to keep going. And that is, what's the new administration going to do to the market? Well, the one thing I wanted to point out is the market it's called an exchange for a reason. If you're selling a stock, somebody else is buying it. The company's not buying it. The stock exchange isn't buying it. Another individual's buying it. So if you're selling a stock because you believe it's going to fall, someone else is buying it because they believe it's going to go up. So it's kind of a net sum game to the company. It is important to them, the value of that stock. But as far as the value on the change, it's actually a perception between two people. So when somebody asks me about how the market's going to do, I look back all the way to Harding, and we're talking a lot of years here. So it shows what party they were with, Republican or Democrat, how many months they were in office. the total return on the market, which is the Dow Jones Industrial Average over their term, and then the average month, and then I annualized it. So you can look down this list, and generally what we have said over and over and over is over any 10-year period, the market's going to go up on average about 10%. Now, if you're going to try and time it, that probably isn't going to work. The worst per month period was during the Hoover administration. That's not that big of a surprise. The biggest movement, if you come down here, was under Coolidge was the biggest. The second biggest in what we would call modern times is under Clinton. So in average, you've had the typical average term for a presidency is 70 months. And over that time, they have about a 10.7% average return on the market. So those are the things that we look at. We don't weigh it on necessarily who is president, what party's in presidency. What we really look at is the market itself. Some of the monetary policies do have an effect. The one issue that I'm getting a lot of questions are on, since Congress and Senate now are both Democrat run, will that affect it? It will to some extent, but I don't think it'll be any overriding issue. So on average, we see a 10% growth in the market. Yes, we have some down years, but if you look there, there's only in the average annualized return of all of these, there's only 3 that were negative. And that's actually pretty positive for when you stand back and look at the market. And I've said before is don't look at the trees, look at the forest, step back and look at how it does the whole time. And we've had some folks, and I've got some friends that do this. They've had some clients want to get out of the market entirely because of the new administration. And here I'm trying to point out that there's some comfort in the fact that regardless of the party, regardless of the president, generally the market moves up. So I want this to comfort people and look forward to it. Yeah, we're doing okay. So Mallory, that's where we are. This is my 21 forecast. There it is again. I'm sticking with these numbers. I posted these about a week ago, maybe 8 days ago, and I'm kind of sticking with these right now. I think my S&P 500 is probably aggressive, but I also hope, like there's a couple of issues with there. The S&P 500, as I had a client send me an article that one stock is weighted pretty heavy and has done very, very well, and that may be affecting it. But I'm going to stick with these numbers. My unemployment, I still say will be at 6.2% July 1st. That's not that much of an improvement from where we are now, but I'm saying by December 31st, we'll be at 5.5%. And I refer to what my father used to always say, 5% of the people don't want to work anyway. And that's probably pretty accurate. So we think that recovery will be back, and Jerome Powell is probably correct. We'll get a new chairman in the next month, and we have a couple of things going on. Other than that, we have an administration coming in next week. That should be peaceful. We'll have a nice change of power, and we'll take it from there. So send any questions that you have to Mallory or I, and we'll get those into the next program. We'll be back here next Friday morning at 8 o'clock. If you have anything, give me a call, give Mallory a call, or send us an email. We're both available. And again, I can't thank Mallory enough for always being there. I was a little bit late today. I was afraid I got her in a panic, but she does an awesome job bringing this all together and putting it on. I really appreciate it. Thanks for joining us. Tell your friends to come on in, and maybe they'll learn something. We'll be happy to help them out. And let's talk about the market next week, and we'll have some market insights with Mike for 2021. Thanks for joining us.